There are 756 billionaires in America right now. Last year, they collectively got $200 billion richer. The IRS collected about $14 billion in taxes from them. That's a 7% rate. You probably paid more than that. But here's the thing. It's not a loophole. It's not even tax evasion. The system is working exactly as designed. And once you understand why, you'll realize that fixing it isn't a matter of political will. It's a matter of physics. Let me show you what I mean. In 2007, Jeff Bezos was worth about $8 billion. By 2020, he was worth $180 billion. That's $172 billion in gains. He paid $0 in federal income tax in 2007 and again in 2011. Between 2014 and 2018, his wealth grew by $99 billion. He paid $973 million in taxes. That's a 1% tax rate. Now, before you get angry, you need to understand something fundamental. Jeff Bezos didn't receive $99 billion. He didn't get a paycheck. No money entered his bank account. His Amazon shares just became more valuable. And in the eyes of the IRS, that's not income. This is the core of everything. Wealth and income are not the same thing. When you work a job, you trade time for money. That money hits your account. The IRS sees it. They tax it. You can't hide it. But when you own assets, stocks, real estate, companies, those things can grow in value forever. And until you sell them, that growth is invisible to the tax system. It's called unrealized gains. And unrealized gains are not taxed. The entire architecture of American tax law was built in 1913 around a simple concept. We tax income, salary, wages, dividends, interest, things that can be measured in dollars changing hands. But wealth is theoretical. It fluctuates. It's based on what someone else might pay for something you own. And the government decided a long time ago that they can't tax theory. So here's what billionaires do instead. They don't sell, they borrow. Let's say you own $1 billion worth of stock. You want to buy a $100 million mansion. If you sell $100 million in stock, you owe capital gains tax. That's 20% federal plus state taxes in many places. You're losing $25 million to the IRS. Or you could go to Goldman Sachs and say, I have $1 billion in assets. Lend me $100 million. They'll do it. The interest rate will be low, maybe 3%, because the loan is backed by your $1 billion portfolio. You get your $100 million, you buy your mansion, and you pay $0 in taxes because loans aren't income. Now you're paying $3 million a year in interest instead of $25 million once in taxes. And here's the beautiful part. That $3 million in interest, it might be tax deductible depending on how the loan is structured. The system just paid you to avoid taxes. This is called buy, borrow, die. You buy assets, you borrow against them. You live off the borrowed money tax-free. And when you die, your heirs inherit those assets at their current value. All the gains that happened during your lifetime, they vanish. The tax bill resets to $0. It's called set-up basis. It's been law since 1921. Every billionaire in America uses some version of this. It's not a secret. It's just so far removed from how normal people interact with money that it feels like a glitch, but it's not. It's a designed outcome. Now you might be thinking, okay, so tax unrealized gains. Some politicians have proposed exactly that. There's just one problem. It breaks everything. Imagine you started a company in your garage. 10 years later, it's worth $10 billion on paper. You still own 60% of it. Congratulations, you're a billionaire. Now the government says you owe taxes on $6 billion in unrealized gains. Let's say 25%. That's $1.5 billion. Where does that money come from? You don't have $1.5 billion. You have shares in the company. To pay the tax, you'd have to sell shares. But if you sell too many shares, you lose control of the company you built. And the act of selling billions of stock crashes the price, which means you have to sell even more to cover the same tax bill. The math spirals. Oh, and what happens next year when the stock drops? Do you get a refund? Does the IRS cut you a check for $500 million because your net worth went down? If not, you're taxing volatility. If so, the federal budget becomes a casino. This isn't theoretical. France tried a wealth tax in 1982. They refined it over the years. By 2017, more than 10,000 millionaires had left the country. The tax raised about $5 billion a year, but the economic activity lost from those departures cost far more. France repealed it in 2018. Even Norway, which still has a wealth tax, sees about 100 rich families leave per year. Capital is mobile. Borders are optional for the wealthy. So the problem isn't that billionaires are cheating. The problem is that the thing we want to tax, wealth, is fundamentally different from the thing we know how to tax, income. And every solution breaks something else. Here's where it gets darker. The longer this goes on, the more entrenched it becomes. Because billionaires don't just avoid taxes, they use the money they save to shape the system that taxed them in the first place. In 2021 alone, the top 20 wealthiest Americans spent over $170 million in lobbying and campaign contributions. That's not corruption in the legal sense. It's return on investment. You spend $170 million to make sure the laws stay favorable. Those laws save you tens of billions of dollars. The math works. And it's not just lobbying. It's think tanks, research institutions, media organizations, philanthropic foundations that double as influence machines. The people writing tax policy often come from law firms firms that represent billionaires. The people who could change the system are frequently the ones who helped build it. There's a term for this: regulatory capture. It's when the industry being regulated gains control over the regulators. It's not a conspiracy, it's just incentives playing out over decades. The IRS itself has been starved. Since 2010, its budget has been cut by 20% in real terms. The number of auditors has dropped by 30%. And who gets audited now? Not the billionaires with teams of lawyers. The IRS audits poor Americans who claim the earned income tax at 5 times the rate of everyone else, because those audits are easy. They're automated. A billionaire's return can take years to unpack. The IRS doesn't have the resources, so they don't try. In 2022, the agency audited just 2.3% of millionaires. In 1990, it was 11%. The system has slowly digested itself. And here's the part that should make you uncomfortable. This might be unsolvable within the current framework, because the framework was built when wealth meant land and factories, physical things in specific places. But modern wealth is code, intellectual property, financial instruments that exist in server farms. You can move $1 billion across 6 countries in 11 seconds. Borders don't mean what they used to. Jeff Bezos moved to Florida in 2023. Why? Because Florida has no state income tax. If he sells $10 billion in Amazon stock while living there, he saves $1 billion compared to Washington State, which just passed a capital gains tax. That's $1 billion for changing your address, and that's just state to state. Imagine country to country. Some billionaires have already gone further. They renounced citizenship. Eduardo Saverin, co-founder of Facebook, gave up his U.S. citizenship in 2011, right before the Facebook IPO. He became a resident of Singapore. No capital gains tax. He saved an estimated $700 million. The U.S. has an exit tax for people who do this, but it's complicated and capped. And once you're gone, you're gone. There are now entire industries built around this. Citizenship by investment, golden visas, tax havens. Tax havens aren't just islands anymore. They're mainstream. Portugal, Malta, the Caribbean nations. You can buy your way into a tax-friendly jurisdiction for a few $million. If you're a billionaire, that's rounding error. So what's the answer? There might not be one that doesn't require rethinking everything. A global minimum tax, a system where wealth is reported and taxed internationally with no escape hatches. That would require every major country to agree and enforce it simultaneously. The OECD tried this with corporate taxes. They got 140 countries to agree to a 15% minimum. Then Ireland, Switzerland, and the Netherlands quietly carved out exceptions. It's already falling apart. Or you do something radical. You redefine income. You say that borrowing against assets above a certain threshold triggers a tax event. You force realization. But that requires Congress to pass a law that every billionaire in the country will fight with infinite resources. And Congress is funded by those same people. The uncomfortable truth is, the system isn't broken. It's working exactly as the people with power need it to work. And the people without power don't have the leverage to change it. That's not cynicism. That's just math.